About a month ago, I did a video on my 111 options trading strategy. This strategy consists of buying a debit spread where the cost is financed by selling an additional put or call. The beauty of this strategy is that it has a built-in hedge if the trade starts to go against you. The hedge widens your break even and increases your probability of profit. I will leave the link to the full tutorial video in the pinned comment down below. As this is my go-to options trading strategy where I place 3 to 5 of these types of trades every single week, I wanted to share more of these trades with the OGT community. So in this video, I'll be walking you through a recent trade on the Russell 2000 ETF IWM. If you want to see more of my live trading tutorials, make sure you smash that subscribe button and gently tap on that bell notification. So here is the options chain for IWM on the Tastyworks platform. I'm using the Tastyworks platform as it's easier and more visual to walk through the makeup of this trade for this tutorial video, but I place all my trades using interactive brokers where I'll show you my current live position later in this video. You can see that we're using the April monthly cycle, which has around 37 days left till expiration. IWM is currently trading at just under $172. The first part of the 111 trading strategy is the debit spread. In this case, I did a 164-160 put debit spread. I always place my debit spreads out the money. The final part of this trading strategy is to place a further out the money put or call to finance the debit spread. For this trade, I sold the $150 put. Now, it's really important that you always set up your strikes so that you open the trade for a net credit. You can see that we have opened this trade for a net credit of $116 with a 93% probability of profit. The reason for such a high probability of profit is that we have zero risk to the upside since we've opened the trade for a net credit. You will also see that the max profit for this trade is $516. This is because if IWM drops in price, the debit spread will start to print money. I will realize the full $516 if IWM closes between 155 to 160 at the date of expiration. So let's head over to Option Strat so you can visually see how we make money on this trade. If you want to visualize your own option strategies, you can always get started with Option Strat absolutely free using my link in the description. So I've recreated the trade and you can visually see what happens to the trade at different prices. As we open the trade for a net credit, you can see that we have zero risk to the upside and the maximum we can make is the net credit that we initially receive. If IWM was to drop in price, our debit spread hedge will start to kick in where we can potentially realize the max profit. So the way the max profit is calculated is using the width of the debit spread, which is $4 in our example, plus the net credit received. In this example, $1.16, which gives us $5.16 or $516. The debit spread creates a wider break even. So in our example, that is $149.84, which is 13% away from the current price. And again, because we're using an ETF, a 13% move is a very big move, whether that is uptrend or a downtrend. So here's a screenshot of my interactive brokers account of the exact same trade. You can see when I placed the trade, we made slightly less credit than what I was showing earlier of $91. And you can see I'm currently up on this trade just under $10. If you want to know how I will manage this actual position, if IWM goes up or if IWM goes down, check out this full tutorial video on the screen now, and I shall see you there.